Over the next 4 years, the global economy is heading into some, well, pretty wild territory. You see, depending on which forecast you look at, we're either staring down a major slowdown or we're gearing up for a massive boom. So let's dive into this fascinating contradiction and see what the data is really telling us about where things are headed.
And that brings us to the big question, right? How can we have one single global economy, but two completely different stories playing out at the exact same time? Why are some assets, like industrial commodities, expected to fall off, while others, think gold, tech stocks, even Bitcoin, are predicted to just soar? Well, that's the great divergence we're going to unpack right now.
So here's our game plan. We'll start with the big picture, this diverging future and the global slowdown that's really setting the stage. Then we'll look at the two sides of the coin. The commodity is facing some serious headwinds versus the safe havens and tech stocks that are set to surge. We'll even zoom in on how this all plays out in a specific country, using Brazil as a case study, before tying it all together to figure out how to navigate the road ahead. Okay, so to really get a handle on this split, we have to start with that big picture. And right now, the consensus from all the major players is that the main engine of the world's economy, it's starting to cool down. Just take a look at these projections for the next few years. Big institutions like the IMF and the World Bank are all forecasting global growth to hover just under 3%. Now sure, that's still growth, but, and this is the important part, it's way below the historical average. The key takeaway here is that the overall pace of the global economy is tapping the brakes. And this slowdown isn't spread out evenly. Nope, it's really concentrated in the world's two biggest economies. You've got the US projected to slow down, and China is expected to cool off as well. And what's behind this? Well, it's things like rising trade barriers and a whole lot of policy uncertainty, which are creating a real drag on global demand. Now, a huge knock-on effect of America's slowdown is what's predicted for its currency. As this idea of U.S. economic exceptionalism starts to fade a bit, major banks are projecting that the dollar index could weaken a lot. We're talking a potential drop of up to 10% by the end of 2026. And a shift like that, it sends massive ripples across all global markets. So how does this global slowdown actually affect different assets? Let's start with the first side of our divergence story, the commodities that are getting pulled down by this weakening demand. And this slide just lays it all out, doesn't it? It's a tale of two completely different markets. On one side, you have industrial workhorses like iron ore and oil facing some serious pressure. But on the other, assets like gold and tech stocks are on a totally different track, all happening within the same global economy. It's fascinating. Let's look at iron ore first. The forecast is for a steady decline. And the reason, well, it's your classic supply and demand story. The world's biggest buyer, China, is slowing down its construction and industrial sectors, which means they just don't need as much steel. At the same time, you've got massive new mining projects coming online, flooding the market with more supply. Less demand plus more supply, it equals lower prices. Simple as that. And it's a pretty similar story for Brent oil. Projections show prices cooling off as we head towards 2026. The key reason? Global supply from all over the world is just expected to grow faster than global demand. And with the major producers holding plenty of extra capacity in their back pocket, they can easily ramp up production to squash any big, lasting price spikes.
Okay, so that's one side of the coin. Now let's flip it over and look at the other side of the story. While the physical economy is slowing down, a totally different set of assets is getting pushed higher thanks to a mix of uncertainty and a massive wave of innovation.
I mean, just look at gold. JP Morgan has put out this eye-popping forecast, $4,000 an ounce by 2026. So you have to ask, what on earth could drive that kind of a surge?
Well, it really just comes down to gold's timeless appeal as a safe place to park your money. In a world with slowing growth, political risks, and fears about currencies losing value, investors, and this is really important, central banks are flocking to gold for stability. It's the ultimate insurance policy for when times get weird.
But you know, that forecast for gold might actually seem modest compared to what some analysts are seeing for Bitcoin. Standard Chartered is projecting a price of $500,000 by 2028.
That's a number that just screams that a monumental shift is happening in how mainstream finance thinks about this asset.
And the driver here is crystal clear: institutional adoption. The approval of those Bitcoin ETFs in the US completely changed the game. It basically opened the floodgates for billions and billions of dollars in new investment. You combine that with a scheduled cut to new supply in 2028, and, well, you've got a very powerful recipe for a price explosion. And finally, let's talk about US stocks. Even with this broader economic slowdown we've been talking about, the S&P 500 is still projected to keep climbing. Now, strong corporate profits are part of that story for sure, but the single biggest driver, the one everyone is buzzing about, is the incredible power of artificial intelligence. Investors are betting big that the ability to make money from AI is going to fuel a whole new wave of growth, pushing the market to new highs.
Okay, so we have these huge global forces pushing and pulling the market in different directions. But how does that actually play out on the ground in a specific country? Let's take a quick trip down to Brazil for a really fascinating case study.
Now, don't worry about absorbing all this data. Just focus on two numbers here. The Selic interest rate, it's projected to be a whopping 15% in 2025. And at the same time, inflation is still stubbornly high, over 5%. That paints a very, very different economic picture than what you see in the US or Europe.
And this is just a perfect example of how these local pressures crash into global forces. So while Brazil is exposed to all the same trends we've been talking about, it's also fighting its own internal battles with super high inflation and interest rates. It all creates this uniquely complex and challenging path forward for them. Okay, we've covered a ton of ground, from commodities to crypto, from China to Brazil. Let's bring it all home now for one final crucial takeaway.
When you boil it all down, the story of the next 4 years isn't a simple one. It's not just up or down. It's the story of a great divergence, this widening split between the real-world economy of stuff and demand and the financial economy of innovation, risk, and uncertainty.
And that leaves us with one final question to chew on. In a market that's this divided, where some things are falling while others are absolutely soaring, understanding the forces behind this split is more important than ever, because the real key will be figuring out how to navigate this divergence to find where the opportunities are hiding. Thanks for watching.